And next we'll hear from Dr. Fraser Jindal.
Thank you very much. I was asked to look at how international policymaking institutions can be made more responsive to the needs of developing countries. And I approached this question in three parts. First, looking at what are the needs of developing countries, and I looked at outcomes. Clearly, one of the needs is growth, meeting the Millennium Development Goals. Another is inputs, looking at how they can get access to greater capital and financing. And thirdly, look at the process, the question of ownership or inclusiveness in these international policy-making institutions, World Bank, International Monetary Fund, G20, and others. Secondly, I asked how are the international institutions operating today to meet the needs, and that's where I really wanted to focus on governance and look at what I would call the decision-making structure, shares and chairs, shareholders and chairs on the boards of these institutions, the financing windows, and the effectiveness of the institutions. And thirdly, look at what reforms are being made today to forecast the future, to look at how necessary, how feasible and viable these reforms are. And I'll do this in 5 to 7 minutes. As I see the problem, and I'd like to illustrate the problem for developing countries by looking at African countries as the case. And I think that initially we all had hoped that Africa would be shielded from the global financial and economic crisis because it wasn't as integrated into global markets. In particular, most African countries weren't exposed to these derivative products and to these mortgage-based securities. Perhaps South Africa had the greatest exposure with its banking system, and a little bit Nigeria, but for the most part, Sub-Saharan Africa was not part of that global system. But what we're seeing today is then what we call the follow-on effects of the crisis hitting Sub-Saharan Africa. First and foremost is simply that the contraction of the global economy is having an impact on Africa. It's having an impact in terms of trade. Most of these countries, their economies are growing through export commodity trade. It has fueled growth in the past, and today we're seeing that the rich countries aren't consuming as much, and the trade, their ability to trade and to get revenue through trade is no longer as robust. Secondly, there's no trade financing in the system due to the limited liquidity in the system today. Money essentially used to facilitate trade deals. For instance, maybe Standard Bank would provide some money to a company, Cargill, to buy cocoa from Ghana. Well, that financing, which was done primarily through private capital flow, is no longer in the system. And so trade financing is a big problem. Private investment, foreign direct investment has gone down, again because of the less liquidity as well as less risk-taking. Remittances are going down. People are out of work, and they are, unemployment and recession in wealthy countries means that workers are no longer sending money home. That was a huge source of income for African countries. Tourism receipts are also down. But the big negative impact is really on trade and on investment flows into Africa. So it has had these follow-on effects even though the countries weren't integrated into the specific sectors that were hit. And what is more true of poor countries is that they are being hit by exogenous shocks more frequently. And the cost is extremely high, especially for commodity-based exporters. The food price increase was an exogenous shock. The fuel price increase was an exogenous shock. Now you have these financial crises, natural disasters, all can knock the economies off track. The consequences of these exogenous shocks and of the crisis in the financial markets can be felt in human terms as well in terms of the macroeconomics. On the macro side, Africa is expected to grow at lower than 2.9% GDP rate in 2009, which is down from 5.7 in 2008, which is also down from 6% in 2007. And in fact, in the last decade, African countries have been growing at 6 to 10%, with countries like Angola really up there 25, 28%. And now we're talking about 2.9%. Well, what does that mean to individuals? It means lost jobs. It means firms failing. It means people not having access to health care. It has a devastating impact at the micro level. Jobs are gone, livelihoods are gone. And so the consequences are extremely dire in these poorest countries. So the second part is, how are international institutions operating to meet these needs, to address the challenges both to the economy as a whole, but also to the individuals, citizens of these countries. One area that I'd like to focus you on is the ascendance of regional banks, the importance of the regional banks in addressing the financial crisis. The G20 essentially told the regional development banks to fill the gap in financing, which was no longer available from the G20 or major economies and the international financial institutions, the IFIs. The G20 also asked the regional banks to front load the grant money. And so, for instance, today the Africa Development Bank is providing 4 times more lending and grant making than it did just a year ago. So it's basically engaged in what we'd call counter-cyclical leveraging of its balance sheets. The problem with this is it was a good fill gap measure, but the problem with it is that now these regional banks need to be recapitalized. The Africa Development Bank, for example, has no more money, essentially, to give out in grants and loans, and its replenishment cycle would actually come at the end of 2010. And so what do you do now in between now and the end of 2010 to help replenish the Africa Development Bank, because it has increased its lending and its grant making? So that's a key component, is the role that regional institutions can play to try to fill the need of the financing for these poorest countries.